Hello, I'm Annabel Brodie-Smith, Communications Director of the Association of Investment Companies. Today we're taking a look at the prospects for markets and the investment company industry in 2017. Looking back at 2016, Macmillan's quote, "Events, dear boy, events," comes to mind, with the UK voting for Brexit and Trump winning the US election. Despite some market volatility, I'm pleased to say the average investment company is up an impressive 12% this year to the end of November, and the industry's assets are 154 billion. Enough of the past, let's move on to the future. I'll introduce the managers here with me today, and we are very pleased we're joined by managers of three very well-known investment companies. So we have Bruce Stout, manager of Murray International in the global equity income sector.
Hello.
We have Peter Ewins, who's manager of F&C Global Smaller Companies in the global sector.
Hello.
And James Henderson, manager of Lowland, Henderson Opportunities and Law Debenture Corporation.
Hello, Annabel.
Right, on to the questions. What are the key causes for optimism in 2017? And I'm going to start with you, James.
Well, I sometimes sit at my desk in the evening and think about all the problems that you were talking about, Trump and Brexit, but then I look at companies and see the cash generation that's coming through, that's been fueling this good dividend growth we've been seeing, and I feel happy again. So leaving aside the big macro stuff, a lot of companies are doing what they do, managing themselves well and growing. And that's, at the end of the day, the reason we're buying companies. We're not buying markets, we're buying companies. That's why I am optimistic.
I think that's a very good point. Peter?
Yeah, I mean, I would share some of those sentiments. I'm a smaller companies manager really, so I focus very much at the company level. But from a macro point of view, I think there are some grounds for actual optimism. We've been through Brexit. Obviously that's an on-running saga, but the markets have taken that sort of in their stride. And we've had the US election shock, which again the markets have reacted positively to from an equity point of view. There are other grounds for optimism, maybe around corporate taxation. So one of the ideas for next year is that US corporate taxes might come down post the change of government. There are companies, companies around the world, as James has said, that are delivering good profitability. We're seeing that on our portfolio, and I think there's a lot of grounds for taking a positive longer-term view around equities.
Excellent. Now, Bruce, I joke because I say you're never optimistic. But what are your causes for optimism for next year?
Well, I don't think it's a case of not being optimistic. We just try to be realistic, and I think one of the main trends in the last few years is how difficult it's been for savers. They've seen their savings eroded, especially in bond markets, and it's been very tough to keep up in real terms. So I would hope next year that we can start to have some normalisation of interest rate policy around the world so that savers can again get some income from their bonds. That will mean a difficult environment perhaps for equities because bond yields may well rise. But that would be one cause for optimism if we could get some decent saving returns again in bonds for savers.
I know, and I'm sure that would make savers very happy actually.
Well, I would hope so.
Yeah, so what are the key causes for concern? And I'm starting with Bruce on this one.
Yeah, I mean, we've seen a real rise in nationalistic populism this year, and I think the conundrum that is most difficult to marry is rising interest rates and rising indebtedness. It's difficult to square that, and therefore we remain cautious to see how that ultimately plays out. But hopefully a muddle-through scenario will emerge and we'll get through it.
Let's hope so. Peter?
Yes, I mean, on the political side, we've got Europe maybe taking centre stage from here in the next year with elections over there on the continent. The populism results that we've seen this year could be repeated again and could cause more volatility. We've got this issue which I think a lot of us are worried about in relation to China, in relation to the level of indebtedness within that country and within the banking system, a lot of non-performing loans there. How will that play out? And then I think to Bruce's point, I think the interest rate, what we've seen already post the US election is the rise in bond rates. At some point in time, the equity market starts to get worried by that. At the moment, we're taking it as a positive sign that the economies are back on track, but actually at some point in time, higher bond rates hurt equity valuations.
Yes. James?
Well, I think inflation is a possibility in the UK, and that higher level of inflation is a concern. At the same time, GDP growth won't be very strong. So, but in all these scenarios, there will be successful investments and we'll have failures too.
Yes, well, it's always the case, isn't it?
Yes.
So, Bruce, moving on, what regions do you think will be the winners and losers next year?
Well, we're always fortunate at Murray International in as much as we have the world as our opportunity set, so we can pick stocks or bonds anywhere around the world. But the companies do have to satisfy the criteria of being able to grow their profits and also to be able to grow their dividends. So we look for businesses in regions where they have a tailwind rather than a headwind. So we're looking for places where interest rates can come down, where perhaps corporate profits can be higher than expectations. And to do that, we tend to have to go back to Asia, we go back to Latin America, we go back to areas that have underperformed over the last few years, but where balance sheets are strong, corporate profitability has operational upside leverage, and dividends remain good. So Asia and Latin America are predominantly the two areas that we think over the next 1 to 2 years could deliver above expectations.
Interesting, and obviously, emerging markets have had a pretty good year this year.
Yeah, not bad. I mean, it has to be put into the context of the last 5, where we've sort of seen net withdrawals from the asset class for the last 4 or 5 years. So there was a bit of a rebound, and the pessimism levels were so high at the beginning of the year that was expected. But we really need to see the follow through in the next few years to get a sustainable trend.
Peter, what are the prospects for smaller companies in 2017 relative to larger companies?
Yeah, smaller companies, I think you always need to look at individual market by market. So this year we've had markets that have done well in a smaller company sense. US small caps have done well, particularly post the election news. Japanese small caps have beaten Japanese large caps, helped by the Japanese large caps to a degree held back by strong yen. So each market sort of has its own influences. In the UK this year has been more of a struggle for small cap because Brexit has created a search for overseas earnings, which really tends to favour the large stocks. So, you really have to look at individual markets and take them one by one. I mean, I think as a general rule of thumb, we feel that if global PMI data is improving, if it's above 50 and it's improving, that's a healthy environment for global small cap pretty much around the world. If global PMIs are weakening, and certainly if they're below 50, then that's not a good environment for smaller companies. And at the moment, the evidence has moved a little bit more favourably towards PMIs edging back up. So I think, take that as a slight positive.
Okay, well, that's good news. Talking about the currency effect, James, it's been a tough year for the UK with the currency impact following Brexit. Which sectors do you think are well positioned for next year?
I think industrials, if you're producing in the UK at the moment and you're selling overseas, you've had a sort of 15% price advantage in your market. So that's, and we're seeing it already, some of these companies being able to sell a bit more overseas. At the same time as the overseas investor says, look, these companies are cheap for a dollar buyer, and we're already seeing big US corporates buying some UK companies. It was ETV yesterday, at a substantial premium. And it'd be sad to lose too many of these companies because they could be on the cusp of seeing good earnings and dividend growth because of this advantage of a lower sterling in their markets. So yes, I was pleased to see the bid for ETV yesterday. It benefited Henderson Opportunities. But I wouldn't want to see too much of that. But it's just good to have it in the background there that if these companies that are good, solid business franchises fall too low because people are so worried about Brexit or anything, then there is this route where the overseas buyer comes in. Meanwhile, operationally, if you're manufacturing in the UK at the moment and you're selling to the States, selling to Europe still, you aren't in a bad place.
Yes. So finally, what do you think is important for your investment company in 2017? Bruce?
Well, I think dividends are always important. They sort of come in and out of fashion. In certain markets, they're not regarded as that important, such as Japan and the United States. But I think for a lot of individual shareholders who own investment trusts, dividends are very important. What we do know is that in the last few years, companies have not been investing. CapEx has been very, very low in this cycle relative to previous times. And we do know in certain markets that dividend coverage now is very, very stretched. So we have to look deep into companies, make sure they have a lot of free cash flow, make sure they're still investing for the future, but have surplus cash to return to shareholders. because higher yields don't mean you get the dividends. Often the higher the yield, the more chance the dividend will be cut. So it's all about balance sheet strength, and it's all about seeing companies with a desire, a will to return cash to shareholders, and that's what we'll be looking to capitalise on this year.
Well, dividends are very important for our shareholders. A lot of them choose the investment company structure because of our income advantages when it comes to dividends, our ability to pay dividends year in, year out, increasing them.
Correct.
Peter, what's important for your company?
I think from every year is going to be different in terms of the macro influences and what's going on in the markets as a whole, but really we have to focus a smaller companies fund on the individual companies we're invested in. So we have around about 200 individual investments, including some fund holdings. It's about making sure that we pick more winners than losers, obviously, and try and outperform the benchmark the same as ever against the backdrop that we face from a macro point of view. I think the other thing, obviously, which we haven't really talked about so much, is for next year. I think it's very important for the markets as a whole that we don't see trade protectionism movement strike across the markets and impact on global growth, because certainly from the small cap point of view that would be very unhelpful if we were to see protectionism taking hold across the markets.
I mean, there's a lot of concern with Trump that might emerge.
I think it's it's too early to say really how it's all going to play out. I think we're seeing daily news is coming out on a day-by-day basis, which seems to be somewhat contrary to previous indications around policy in relation to individual sectors as well. So I think
seems to depend on his latest tweet.
Well, we'll see. We'll see what comes through. But from a small company's point of view, it really does come back to individual fundamental analysis of the individual companies, as Bruce says, looking for cash generative companies that can generate good cash flows, that can pay out good dividends. And our fund has got a 46-year track record of dividend growth, which we want to try and maintain. So hopefully those dividend flows do continue to come through.
Yeah, I'm sure a lot of our shareholders will be very keen to hear that and be looking for those dividends to come through. James, what's important for your company?
That I work hard. Because in the UK, just take the UK market, there are probably 1,000 companies that we could invest in, and there are going to be some very big winners in there. And it's to not get down too much by reading the papers in the morning, but actually looking at companies and company reports. There'll be some substantially successful businesses on AIM, for instance, coming through in the next few years, and to be involved in some of those in their fundraisings over the next year. So it's hard work, getting out of the office, not being hit too hard, worrying too much about the forces from outside, because good management teams with good products that are providing excellent service will come through and grow, and we need to be involved in them.
Excellent, James. You keep at it.
Thanks, Jennifer.
Well, I'd like to thank our managers very much for joining us today.
Thank you.
Thank you very much.
Thank you, Jennifer.
It's interesting to hear their views, but I'd like to emphasise that we don't have a crystal ball, so we don't know what's going to happen in the future. Investment is for the long term, and you need to have a well-balanced portfolio. If you're in any doubt, you should talk to a financial advisor. All that remains is for me to wish you a Merry Christmas and a Happy New Year.